Well, good evening, everybody, and welcome to the June 2023 Investing Roundtable. My name is Mark Robertson, and just glad to be here with all of you tonight. Welcome. We are joined here by some wonderful investing colleagues. First of all, I'd like to say happy returns to Kim Butcher. Kim Butcher, formerly of Florida. I believe she's in the middle of relocating back to the dear old Midwest. So, Kim, how are you tonight?
I may be staying here more than in the Midwest.
Well, yeah, you're going to transition back, aren't you?
I may transition 5149.
There you go. Well, you definitely
that's enough to keep the tax man happy, right, Kim?
Well, it's much the tax. Kim is much happier with the tax man where she's at in Florida.
That's what I mean. Yeah.
And then we're also joined here tonight by a friend who has been with us a few times in the last few months, and as much as he annoys me, Kevin Gologly from the Baltimore, Washington, D.C. area. Welcome, Kevin.
Boy, with an introduction like that, I feel like I might as well go to the doctors. I feel like penicillin.
A great way to make people feel welcome, Mark. Okay.
Well, it's all in a good way, though. I mean, it's
okay.
If within this group, if you can't get used to getting teased, you can't survive.
All right. And last but not least, our dear colleague, our investing raconteur from mid-Michigan, most recent winner of a bunch of awards. He just runs around with a shopping cart of awards at national conventions, Ken Kavula.
Well, thank you, Mark. I appreciate it.
Mark, just like the actors have the EGOT, the Emmy, the Grammy, the Oscar, the Tony and stuff, we basically have the same for BI. And I think, Ken, you've gotten pretty much all of the EGOTs for BI, have you not?
I got a pile of them, and I'm very proud and humbled by the recognition. It's appreciated, and at the same time, I understand that there are a lot of folks in this organization that are worthy of note and regard and as many awards as you can put together. So, Mark, thank you for the mention, and let's get started with this program, okay?
All right, the four stocks that we'll be covering are on the right there. I don't think they're a stranger to many. Now, Charles River will be a refreshing different company, so we'll look forward to Kevin's presentation on that. So let's go ahead and get started. You guys all know the drill. No investment recommendation is intended. This is entirely about education and illustration of the concepts of stock discovery, opportunity discovery, and the analysis of opportunities. So that's what we will be doing here tonight, just giving you our thoughts, our interpretations of some methods that are basically a gold standard for the last 8 decades or so. So that's what we are doing. We, again, illustrative purposes only, and they are our opinions. Please do your own homework. If we do own something, we'll try to remember to point it out. We do send out reminders for this event. We are now coming up at the end of our 13th year, starting year 14 next month. And if you'd like to be reminded about this event on a monthly basis, send an email to nkavula1@comcast.net. If you would like copies of the slides, or if you have follow-up questions or just things you would like to share, our 2 email addresses are there at the bottom. That's Mark and Ken. Anything else, Ken?
No, Mark, we do have a hand in the air, and when we get to a stopping place in the portfolios, I'll unmute for that hand in the air. I do see it, but I'm going to wait just a moment here, okay?
Okay. All right, we're just going to boil things down a little bit and condense a little bit. We've been doing this, as I said, for 13 years, so we're going to make a slight change to just the slides that we put out. And the rules of engagement are there on the left. We're trying to beat the market by 5 percentage points over time. I think you can see that we are pretty close to doing that, although Ken did point out, because he's such a stickler for detail, that we are slightly under the line tonight. So that would be this line right here, trying to beat the market over by 5 percentage points over the long term. And again, that's what the relative return is. The relative return is the answer to the question, how much are you beating the market? The math behind that relative return is right here in the box up at the top. Literally, our rate of return for all of the selections made since 2010 is 15.3%. If that same amount had been invested in the Wilshire 5000, it would be 10.5. So one minus the other, you get a 4.8% return. And before you go panicking about us being below the line, that is still a wow result. That would actually outpace probably 90% or 99% of the active mutual funds out there. So just kind of keep that in context. We do like to see half of our selections beat the market, and we're kind of in tune with that down there at the bottom. So, Ken, I'm sorry that we drifted a little bit below. We can probably slap the blame on one company that shall go nameless for that little bit of a slump, because we're just crossing our fingers and hoping for better days ahead.
Well, I'm still very, very pleased and proud of this portfolio. Mark, I'm going to unmute Darwin Dudley, and Darwin, you have the floor if you have a question or a comment.
No, but I'm glad to be unmuted.
Okay, you are unmuted, but if you don't have a question, I'm going to take your hand down then. And Marie Meyer, your hand is in the air. Marie, I cannot unmute you. You have to unmute yourself. You muted your end. So if you want to unmute yourself and say something, now's the time. Okay, I'm going to take that to an inadvertent hand and take that hand down. And let's continue then, Mark, okay?
Okay, one last slide before we get underway. This is the actual tracking portfolio. What we do ever since 2010 is anytime one of us, either a knight or a damsel or by audience vote, selects any company, we invest $1,000 into that company. So you see the top 20 positions by total assets on this list. There's actually about 90 total positions in the tracking portfolio. These are the top 20. The line down at the bottom does reflect the average of all of them. So down in here, this is the average of all of them. We'll talk about that in a minute. So for example, with Microsoft, we have invested $1,000 into Microsoft 5 times. I know it's 5 times because Microsoft is right there. And it's right in the 5 times ledger. So $5,000 invested in Microsoft is now worth $83,000. So that's good, clean fun, any way you shake it. And so from top to bottom, these are actually looking pretty good. A lot of household names on here, but there are names like, we're having some fun with Ardelyx, obviously. That's a kind of a non-core stock to be sure. But other companies like Air Lease making this list, and Green Brick Partners, and they're just not everyday names. So it is kind of fun to watch the performance of this portfolio as these companies come and go. Now Ardelyx did dip down. It got up all to $5 a share. It's back down to $3.39. So that probably accounts for that dip pretty much, Ken.
Yep. Somebody always asks me what's the best performing stock in the portfolio, and I don't think it's near the top of the list. I think it's down around Costco. That's a one-time selection, and that's almost an 11-bagger. So since selection, the $1,000 in Costco has grown to just shy of 11,000, and I think that probably is our best performer if you're using those kind of metrics in the entire portfolio. The only thing I have to say is how silly were we in not picking it 8 or 10 times instead of just once. Marie's hand is back in the air, Mark, so I'm going to unmute Marie. And again, Marie, if you want to speak to us, you're going to have to unmute yourself. Okay, Marie, your hand is up right now, and I'm taking it down. So that's what a down hand looks like right now. So if you do want to speak to us, try putting something in the question box here. We're evidently having some trouble with the microphone right now. And let's continue, Mark, okay?
All right.
Mark, one thing just on that, with that 83,000 for Microsoft, that includes dividends, or that does not include dividends in that calculation?
Yeah, all of these prices will include dividends. All of these results include dividends. What we do is we use the tax the total return price at the time of purchase. So you're always accounting for dividends and splits. So that's true for all of the companies on the list. So yes, that is a total return result.
So Mark, this is Herb. I don't see my stock NVDA in there. Did you guys end up selling it?
It must be just barely off the list. Keep in mind
this is only the top 20, Herb.
All
So
right.
there's another 60 or 70 on the list yet. We just can't fit it all on one page, and so these are the 20 largest holdings. But be aware that NVIDIA has only been chosen once or twice in the portfolio, and it's a pretty good number for the fact that we've held it for, I think, less than a year. So that's pretty decent. Marie, your hand's up again, and I'm going to unmute you, but I can't. So you'll have to unmute yourself if you want to say something to us, Marie. Okay, I'm going to take the hand down again. It's down now, and we'll see what happens. Go on, Mark.
All right, so we are going to do something a little bit differently. We're going to actually move some of the portfolio decisions to the manifest forum, and we'll also publish the results on Facebook going forward. But just to save time during these sessions, we'll just cut down on that aspect of the meeting unless something really juicy jumps up during a future session. So with that, let's go ahead and go to our first selection, which is a very well-known company, Visa.
Well, I was looking today, thanks, Mark. I was looking today for a stock to present, and I always like to look at the portfolios that I'm involved with. So I looked at my personal portfolios, I looked at the club portfolios. I made a very short list of stocks that don't normally fall into the buy zone. They're rarely in the buy zone, and rarely do they have a nice healthy par attached to them. I was very surprised to see Visa was a buy on all of the SSGs. We hold it in 4 or 5 of the portfolios that I help manage. And I was very surprised to find out that Visa has never been chosen for the roundtable. So we're going to choose Visa tonight, and this is going to be short and sweet. Next slide, Mark. Visa is the world's largest retail electronic payments network. It provides many, many types of services, mainly processing services for transactions and for payment product platforms. Visa's not a bank. Visa will put its name on banks' credit cards, on different company credit cards. My Visa, for example, is branded Marriott. And besides handling transactions, my Visa gives me Marriott points. But Visa partners with banks and companies all over the world. But Visa itself does not hold cash. It does not handle cash. You see the number of transactions that it conducts around the world. You see how many people actually hold a Visa card. About 15,000 financial partners, financial institutions, and that's a $250 million plus financial transactions. These are yearly numbers, and they've been moving in a nice, steady upward stream now, especially for the last 4 years, but generally since Visa began. And Visa is a very large, fairly old company, been around at least 20 years or longer. And many of you recognize Visa from its earlier days when it was just a card. It's now a card plus many other financial services. Next slide, please. Very rarely does a value line synopsis give you all of the hard facts that this value line synopsis gives you. I don't expect you to read it tonight, but if you're interested in the company, I would urge you to start with the value line analyst report. It's dated May 5th. Sharif Abdu is the writer of the report. And again, he just covers fact after fact after fact. You get a lot of your most basic questions answered, and it's amazing how closely he follows some of the things that we follow very carefully on our SSG. Down in the lower right-hand corner, I've also captured Value Line's forward projections, and I'm looking at a revenue projection of about 11.5% and an earnings projection about 13.5%. We'll look at those when I do my SSG, and we'll kind of use those along with some other numbers to help come up with what I think is a reasonable analysis. Next slide, Mark. Here I am on the front of the SSG. Those are really nice numbers. You might notice that for the last 3 years or so, the last 3 fiscal dots on the visual analysis are showing growth a little bit steeper than the trend line. That's what I was referring to as far as growth quickening a little bit more recently. That quickening growth is expected to continue for the next couple of years. The Morningstar numbers on this SSG, which you can find almost in the center of the screen, it's to the right of the graph itself, show a 2-year sales trend projection. These are projected numbers of about 11% and a 5-year earnings projection of just under 16%. I'm putting those with the numbers that I just talked about from Value Line, and then I'm coming up with what I think is reasonable. I chose 11% sales growth, and after using the preferred procedure, I think 12% earnings growth is quite reasonable for that particular choice of sales. I know that the 2 trend lines, the pre-tax profit line and the debt to capital line, show red. But if I look at the data in its entirety from 2018 through 2022, that's the last 5 years, I'm more apt to characterize the data as consistent or level or an amber color rather than a red color. The pre-tax profit, for example, 5 years ago was 62.1, most recently 61.9. I don't think 0.2% at these levels is that much to indicate a downward trend. Same general idea with the debt. It's been in the low to mid to a little bit into the higher 30s. Slightly moving upward, but for the most part, I would call that consistent. And when I look at interest coverage, I find that the interest coverage for this cash-rich company is really, really in good territory. Visa's carrying a lot of cash on its books, and it should have no problems at all servicing its debt. Next slide. Here I am looking at the bottom, or section 3 and 4 of the SSG, and I've decided to use PE values at a high side of about 33, at a low side about 25. That's a little bit high, higher than I normally go for a company, but this is a stellar, high quality company, and I think I'm comfortable enough if I'm going to use growth that I chose. PEG ratios in the 2, 2.5, 3 area don't scare me a whole lot. Average PE of 29 is fairly consistent with where Value Line comes down for its projections on average PE. Visa does carry a dividend with it. Next slide, Mark. and that dividend on an average basis is a little bit under 1%, about 0.8%. I'm getting, with the values that I chose, I'm getting compounded par values of just under 12% per year. At the total return side, just under 15% per year. I would not take these returns if this were a very small company, but this is a gigantic company. This is very, very large, and these types of return for a company this large and this stable are quite extraordinary. I'm going to accept them with no problem. I like to use manifest investing to kind of validate my own analysis. When I look at manifest investing, I see that the par coming from the set of analysts that help Mark determine the numbers in manifest, they come out to be 12.4%. I think that's the same number as my 11.9%. I have some validation. I also checked the brand new member sentiment part of my SSG Plus. I did not put it on my slide, but I will tell you that my judgments, all four of them, my two judgments for growth and my two judgments for PE, are very closely bunched to the median values coming from the member sentiment. There's a large number of SSGs for Visa that make up the member sentiment. So all in all, I'm happy with the SSG. I'm happy with the return, and I'll suggest at least $1,000 into Visa for tonight's program.
Thanks, Ken. I can't believe Visa is not in there yet, but apparently we have missed that one. Before we get started with Kevin, I did want to answer Herb's question about NVIDIA. Herb, you picked it back during the roundtable for June 2021. The $1,000 invested is now $2,094, so it's done spectacularly well. It's a single time selection, so it just needs more time in the oven. But spectacular returns. That, by the way, beats the market by 45 percentage points per year over those 2 years. So NVIDIA is still alive and kicking. All right, so Kevin, we turn to, I'm guessing that is not the Detroit River.
No, that is where the home of the Star Spangled Banner. That's Fort McHenry.
Oh, cool.
And you guys were waxing eloquently about U.S. and Canada at Windsor and Detroit and their big stuff. We have a really big one here, and we're back to having our 4th of July. So it goes all throughout the Fort McHenry, sticks out into the harbor, and it's part of the Chesapeake Bay, and you can see it for miles. So if you guys want to see the place where the Star Spangled Banner was written, was right in that harbor, come and see us on the 4th of July, and we'll celebrate.
Cool.
Anyway, so here's what I'm going to do is I'm going to go through a screening, and then I'm going to also tie it in with a new purchase from my one of my 2 clubs, a Montgomery County Model Investment Club. I'm having some lag problems here. So what I'm going to do is when I say go to the next slide, like now, tell me when you're on there, because I have my other slide open, because I'm just getting some bad connection and bad buffering. So
okay,
bear with me. So if we're on the next slide, yeah, there we are. So yeah, I want to give a real shout out to Ken for giving me a full 4 days notice, as opposed to Mark, who gives me maybe 24 hours if I'm lucky, kind of thing. And so a hat tip to that. And there's the 4 raconteurs going on out, traveling it. That I think are worthwhile. So let's just go to our next slide.
I figured that was the Charles River Bridge behind them or something, and now the audience is beginning to understand me, Kevin.
Well, that's a scary thought when they start understanding you. Anyway, moving right along. So what I usually like to do is I like to start out with the manifest screening tool. And my sort of go-to that I've used for many of the presentations I've done here for the roundtable is the triple play. And we've talked about that several times here. The thing is, when I did this screen on Friday, I did get the stock I was looking at in the triple play. And when I went to do the screen capture this morning, it wasn't there. So what I did is I sort of created something that, you know, would probably be sort of a good facsimile. I wanted a high quality company, so I got a core score of 250. I wanted really good growth, so I got sales growth at 12. And then I wanted something that at least was somewhat interested in the Motley Fool community. So that's a cap score. 3, 4, or 5 would be good. And then I wanted something that was a little beaten down, but not down near the 52-week low. And so I came up with 7 stock ideas. And, you know, Mark, you always like to talk about getting some different ideas. So I'm looking through this and going, you know, both Axios and Charles River are in the Montgomery County Model Investment Club. But you've done Axios once. So I said, well, let me take a look at Charles River. And let's just go to the next slide. And here you'll see I just put up both. I like to do this. I like to hide the names so you can just really look at the visual analysis to see what's going on. And here we have Company A and Company B. And tell me which of those, and I'll ask this of the audience and the other folks in the back room with me, which one do you like? A or B? Anyone? Bueller?
I like them both.
Yeah, they are.
I think B is concave up versus convex down, so I'll go with B.
Okay, good thing. Well, anyways, you can see this is that they both have the again, because of the screening to it, you can see where the current price is down on the 52-week low, and that's sort of where we that's what the screen came up with. But they both look really, really good, and that's sort of what I like to sort of get to. So let's go to our next slide. And so here's our watch list over at, and it's up on Manifest, so you can see the Montgomery County Model Investment Club. And again, you know, we put in that $100 just to sort of track it. And when something falls below, is it a good deal? Is it a table pounder, or is it a value trap? And we can see we have a couple down there that are on the low side in Givity and EPAM Systems, but this one I think may just be a good deal. And that's sort of what I'm taking a look at. And that's, I think we have a pretty decent list on our watch list there. Let's go to our next slide. So let's talk a little bit about Charles River Lab. And it's a diagnostic research company, and it does preclinical and clinical lab services. They're out of the Boston area, hence the Charles River. And here's what I found really interesting. The CEO of this company, Jim Foster, who's been there since '92, is the son of the founder. It's not too often that you see someone as they make that transition from a private company to a public company staying on. But they went through sort of an interesting way to get there, is that they sold it to Bosch and Lombs in '84, and then the son took it private from Bosch in '97, and then they went, then they turned around and did an IPO in 2000, and they are now, just about 2 years ago, they were part of the S&P 500. And this all from buying 1,000 cages of rats from Virginia and bringing them up to Massachusetts. Who knew that there weren't enough rats in Massachusetts? But Charles River is the company and Company B. Let's go to our next slide. Well, one of the things you have to sort of think about when you're in this is that, you know, what are sort of some of the downsides? And the one that seems to sort of show up right away is that, and I saw some of these headlines when I was doing research, is that these people were protesting the dealing with the lab animals. And, you know, we can have a huge discussion on the benefits of it or not, but if that's something that bothers you, then you may want to find a different company. If it isn't a problem for you, then you can go forward. But please recognize that some people are going to say, oh, you shouldn't be doing this, blah, blah, blah. I'm not smart enough to figure it out, but I think you need to sort of take a look at that, PETA has protested them. And Charles River Labs, you know, has more lab rats than any other company around, so they're going to end up, you know, discarding a lot more of them. But that Morningstar ESG score shows that it's really got a low ESG, which is a good sign. And so we're happy with that. So just sort of as an FYI, let's go to our next slide. And so if I were to do an elevator pitch for Charles River Lab, I'd say it's an early stage contract research organization. They're really there at the beginning of the critical early development process of new drugs. So, you know, if you're a drug company and you're trying to do something, you're going to work with someone like Charles River Lab, and you may work with numerous people. And so they're divided up into 3 different segments, and you can sort of see where they are. And here's the nice thing is that they have over 10,000 clients, 2,000 in biopharma. No client is more than 3% of sales, and their top 25 clients are under 30% of sales. So you can see that this is a really well diversified, that they don't have to worry about being dependent on one particular company. And up in the upper right-hand corner, you see that they have an announcement saying what they're doing is good for the animals that are in animals and research. So it's sort of a counterpoint to what we just saw with PETA on the previous slide. Let's go to our next slide. So here's this is how Charles River Lab looks at their stuff. And, you know, what I've done is I've highlighted each of the segments based on what their percentages are. I added this to it, but you can really see they have some big growth. If you see in that manufacturing segment that they're thinking that they can get growth in the 20 to 25%. You can see they've broken out how much each segment can do it. And they think their potential addressable market is over 20 billion in sales, and it currently is a 4 billion sales company. So that's what they think their thing is, and they think long term they can go at 10% quite easily for sales. So keep that in mind as we go through this. Let's go to our next slide. And so, you know, one of the things that Charles River does is they both grow organically, and we'll talk a little bit about that in the next couple slides, but they do a lot of acquisitions. And here's sort of where you can do that. Is I like to sort of search. And when I do searches, I sometimes will not put in the ticker symbol, but I'll put in the name of the company and then put in something like acquisitions. And I end up getting a different universe of stuff to look at than if I were to just put in the ticker symbol, and I'd get stuff that's more, you know, investment and stock oriented. And I want to sort of see what the industry is like overall. But you can see, you know, just a series of acquisitions all the way through. And let's just go to our next slide. And so here's one of the things you can do with your SSG is I took out, you can see I've highlighted the shares outstanding, because when you acquire companies, you've got to do it some way. You either have to dilute your shares and get more shares involved, you've got to take on more debt, or you've got to sit there and use available cash to go through that. And we can see with this that its shares are staying pretty much the same. Debt is mirroring the earnings per share line I have there. Debt's in red. And the thing is that, but it's a little bit less than earnings, which is a good sign. But the thing is that the free cash flows we see really took a dip. And that's from those acquisitions for the last year or so. But the earnings per share is not taking that big of a hit. The problem is, and this is probably I think the bigger weakness than with the PETA, is they have enormous amount of goodwill on their books, okay? 3.8 billion on there, more than their assets. So that's not good. So the question really becomes, do you think that this is going to grow enough so that they don't have to worry about that goodwill? So, but if that's something that's a sticking point for you, you may want to stop. If you don't understand goodwill, there's a couple articles have had hyperlink to it. Let's go to our next slide. So here's some of the competitors, and I like to look at it, as you can see, from a wide range of ones. There are usual suspects up at the top. But what I do, the ones that are in the bottom, Kraft, Owler, and in this case, MarketBeat, again, I put in Charles River Labs and competitors. And again, I get a different range. Sometimes I get some privately held. There's some European ones that aren't in our database, either at Manifest or in the BI tools. And I can sort of then start to see where are some of the ones that sort of come out to there. So I'm sort of looking at, from me in this study, I used MedPace, I used Thermo Scientific, TMO, and I also used SYNH. But that's sort of where I went. Let's go to our next slide. So some of the trends that are going on in contract research organizations in the healthcare industry is that this one reference that I have here says that they're expecting it to grow by 7.2% over the next decade. And that's not even talking about, you know, if there's any more acquisitions from Charles River that they may be able to do it. But they think there's a total addressable market of 40 billion. Now that goes out of areas that Charles River doesn't even look at. But again, it just looks like there's a huge growth opportunity that's going on. And you can see the different areas where this research paper is talking about where they think the big growth areas are going to be in contract research organization. I'm going to say that 3 times fast. Anyway, let's go to our next slide. So we see some of the strengths really great on the new drug discoveries are well positioned. Their addressable market is still there. We got a great core score, excellent visual analysis. And here's another thing that they've touted throughout their stuff is that over 80% of the new novel drug, FDA novel drug discoveries, Charles River has been involved in. It doesn't mean that they're the point person, but in some way they're involved in it. So they're in a piece of the pie several different places. The thing is that, they have a really narrow moat, and they have been targeted of the environmental activists. There is a concern that the contract research organizations, that stuff, the drug discovery spending may be starting to slow to keep that in. But the biggest one is, I think, really the high rate of goodwill. So let's go to our next slide. And so rather than sitting there and going through all the steps, I'm going to give you my judgments, and I'm going to put this up. I'm ready to submit it to First Cut so you can see it in its entirety. But you can see where my judgments were in terms of my future sales and earnings, what I came up with in terms of my high and low prices. And that's with today's closing price, by the way. And you can then see as Mark, or as Ken likes to do, is I like to compare to what I see on Manifest, and I can see my numbers are really pretty close to where they are. You can do that, and I think it's showing with the relative value it's maybe on sale. And again, the evaluate management in the upper right shows it to be a really, really well-managed company, again with the caveat of the goodwill. Let's go to our next slide. So I will put this up there, and here's some more shameless self-promotion. If you want to see more of these things, come to us on the first Monday of the month, second Monday next month, where we look at some of the stocks from BI, and there are links for that. But I will submit that for you, and that is my presentation for tonight.
Well, thank you very much, Kevin. I didn't find that annoying at all.
Me either.
I have witnesses. I have witnesses.
Good stuff. Very well done. It's a company I've wondered about for some time, and it's a company that Hugh McManus has mentioned as a pretty formidable company in that field, and he certainly spends a lot of time in that area.
Well, I want to give a hat tip to one of the people in our club who actually presented it. That's Marilee Hardesty. She's the one who came up with it, and I just took with it, so I'm stealing from the best.
Fantastic. Give our best to Marilee. All right, so let's move on and welcome back Kim. And she's
Thank you.
And you're going to welcome back PayPal.
I'm going to welcome back PayPal, and I guess I'm Lucy tonight.
A good Lucy.
A good Lucy. Okay. Some people I know who I talk about with stocks are some people who aren't members of Better Investing, and I kind of will look the Better Investing way, the Manifest way, and kind of Kim's quirky way. And I'm going to show you tonight on how I look at a stock. PayPal, and this is from Monday night. This was not tonight's Manifest statement that they have as a quality of 82, a par of 18.1. And let's go on further and how I look at it. Today it closed at 66.23, bringing the PE to approximately about a 28. And Mark, with that red pen of yours, can you look at the PE ratio and the trailing and medium? Circle it. Now, if you'll notice, currently that says 21.5, and if the PE was 21 and the trailing was 35, it's nice and lower, but that was at a price of 74. So at 66, it's probably going to be just a little bit lower. The other thing is circle the 18-month target price box range there on the left. If you'll notice here, the midpoint is going to be up to $100, and that's a 35% profit right there. I do recognize that the safety has been lowered as well as the technical. And let's talk about the big elephant in the room. Mark, if you can put a big circle around where it dropped like a bomb. And what happened here is, if you think about it, people, is we had a pandemic, and what happened is everybody used their PayPal a lot more, and they're not using it as much. So we reached a high of 310, got as low as 66.40 is what it looked like in the last couple of years. And we're kind of floating right around there right now. And so we've got people who are probably really disappointed. Next slide. Now, the next thing I really like to look at is, I'm a greedy person. And if I can get 30%, 30 to 50% within a couple years, that's what I'm about. So I like to make sure at minimum when I look at a value line. And my library, I go to my public library and it gives me value lines free. If I show a driver's license, I can get in there and get it. And I can get a 22% annual return versus a 36%. And if you'll notice on the far right, where I kind of missed it over on the end, you can see where the ... is, and you can see the solid black dot down here. Yeah, right there. Look at how that is the projected out stock price, and look how much that's going to go up, because at $66 currently and a low of 165, 66 and 66 is going to be like 132. So it's going to be over your 100% return in 5 years, 120%, and even could be even higher and could be your triple bagger within 5 years. I can't complain about any of that. The other thing you want to look at is, I've always remember that your little dark shaded area on the value line is the recession area. And so that's one of those things that notice that what was going on there with the company. The other thing you want to keep looking at is, always look at the legend box where it says 28 times cash flow per share. And I'm going to show you a little, I call it my quick and dirty discounted cash flow model. Next slide, Mark. Okay, here's the rest of it. And so if I'm looking just at numbers, because we as investors, we make our decisions on the numbers. Hopefully we don't make our decisions based on a gut feeling and all. But our revenues, we know when the pandemic happened, look how low it was at 21.72, because it had dropped, and then it went to 24, 26, 28, and then now it's expected to grow out all the way over to $31.70 a share. So that's about it. If you go at 28 and you go 280 and 280, that's about $5. And, you know, so we're not going to have a 20% growth, probably more like a 7% growth there. Our cash flow per share is going up all the way up to 740. And if you notice, it was at 465. The pandemic happened, it went down to 329. And then it's been climbing back up since then. Our earnings per shares are going to go up because it got as low as 209. It's now 365, 420, and all the way up for 595. So we're seeing consistency in the numbers going up. Now, if you remember, PayPal is basically an asset-light company because they have people who run the computers and they have to have computers. That's about it. And so they don't spend much on the company to have the company work, essentially. So, you know, 80 cents, 95 cents, $1.35. And I have a tendency to lean towards those companies that are asset-light because they don't have as much money built into the business. And look at how that value per share is growing. 1860, 785, 19, 20, 26. Our shares outstanding have been pretty well consistent. We know that we're expecting that PE to be able to expand because it has been lower at 25, and they think it's going to be going out to 35. And notice when it was going on with the pandemic, it was way high at 46, 47. So we're seeing consistently in what the company's doing. We've noticed that for a couple years here, the margins were a little bit depressed from 22 to 19, 22, 23, 27. We're going up. Tax rate has stayed the same. Our profit margin, before the pandemic, it was at 16.4, and then we dropped like a bomb to 8.8. And then they've been dragging themselves out, 13.6, 15, and it's going to go up to 18. Our return on total capital and how they use their money has been It got dropped as low as 8.4, but it's back up to 14, then 15.5, and all the way up to 19.5. So in the numbers of the game of making a decision, all of this looks good to me. Next slide. All right. This is my quick and dirty DCF from the value line. Very simply, you have the legends box is here on the left, and on the right-hand side, I've got from the value line the first box and a half. So if you take cash flow of $7.40 minus dividend of nothing, minus the capital spending per share, because each company has to spend some money to keep the company growing at $1.35, you get $6.05. Then you take the $6.05 from, and you take the legend box and you multiply that out times the $6.05 times the 28. Yep, $169.40. Mark, can you go back a couple slides? Was it what, $66 and change is what it was today? Yeah, $66.23. So by discounted cash of how much company is generating in cash, it should be $169. So yes, this company is really undervalued. So yeah, this makes me interested in the stock. Next slide. This is the rest of it that happened from the value line. Like if we are risk tolerant investors and we got a holding, we can accept and hold on to the stock. And we usually buy a stock expecting to hold on to it for what, 5 years until we double our money. So they really think that this capital appreciation potential over medium and long term is attractive with the present price. They know things have slipped, but here's the company financial strength is A. Their stability is kind of only at 40, and I'm going to explain to you what's going on here. Next slide. Okay, so why does Value Line think this stock is going to go from 66 to what's 169? To me, there's going to be a catalyst, what's going on, and it's happened. It's an activist has gotten involved. This is Elliott Management, and he has bought into the company, and he's telling management you need to be better at how you're running the company. And they have like $5 billion with a B dollars on the balance sheet, and they've had a few acquisitions, which is not done really well. So the CEO, they've kind of felt like, you know, there was no succession plan, and he's 65 years old, so maybe we need to pick somebody new who's maybe going to be a better choice. And he still, Elliott Management still owns, I double checked that, and he's got over $2 billion in ownership. So he's got skin in the game, and he wants this company to do well. Next slide. So what's he doing? And is this, I can tell you that Elliott Management and D.E. Shaw are two companies that I purposely look out for when I'm looking for a stock. If I find something that they've become activists on a stock, because I usually get a nice 50 to 70% pop. And I'm not complaining about that if that could be in 2 or 3 years. There's an article here. You can see the link of how you can, if you want to read all about the fund, but they have, this is one of the companies to be an activist on a company who is like writing the laws of the land of how to do it and be successful, because they are so successful. Next slide. And actually right now I find out that they've got, he's become an activist on Salesforce, and Salesforce has got all kinds of debt on it that it's going to be interesting to see what happens here. And from Yahoo Finance, I saw where the stock underperformance in the last 9 months may make the investors happy that an activist has gotten involved, so that they can get some more value out of it, because it turns out that the CEO, Dan, has made some bad decision making on the company the last couple of years, and it's kind of the stock prices as a result. You can see where it's been. Next slide. When you have 60% ownership and it's BlackRock and State Street and State Street, BlackRock, and oh heck, for the life of me, I can't think of it right now. When you get the big guns involved and then you get an activist, guarantee you they're all talking together about how they think this company can run better. And the activists will make and have a like simple conversation with management of this is what I think you need to do. So next slide. And what's happened? They've put in a new CFO. We got $5 billion on the balance sheet. Why do we have $5 billion just sitting there and doing nothing? So they're starting to buy back shares, and it's a nice low price. So I always do love it when a company is buying back shares, but they're doing it at a reasonable price, because as the stock price goes down, earnings can go up. And that can be good for the company, because then it's going to get recognized by the market. There was a unit, Zoom, which they bought in 2015 for $890 million, and it's not done anything for them. So it was a bad acquisition, and that's the CEO's fault. Next slide. They've also decided that buy now, pay later loan their business is going to get sold off, because they're trying to protect their balance sheet to make sure it's rock solid and shore it up to be nice and strong. Because when you have a lot of this buy now, pay later, if people don't pay, it's going to affect your bottom line. So PayPal is selling theirs off, and they could be getting $1.8 billion of profit, and that will protect the company, because they won't have as much debt that they have to service. Next slide. They've also been laying off people, because when the pandemic started, they hired a lot of technology staff to make sure they could do all the processing that they need to do with the computers. And now people aren't using it as much, so they're laying them off. So they're going to cut their cost and have fatter margins. And this is all good for us as a investor. If you work in the tech industry, maybe not so well, but as an investor, this would be good. Next slide. So they're going to make the balance sheet stronger. And when you have a lot of cash with $5 billion, what are you going to do with it? You could buy another company. You could get more staff because you've got more transactions, but they're going to cut their costs. They're making sure their computers are updated on what they do with everything, and so they're letting staff go. They are buying back shares. They have been paying down debt. No, there is no talk of paying on any dividends yet. But with the cost cutting and being laser focused, less costs going out means more profit coming in. I'm never going to complain about that. Next slide. There's that quick and dirty DCF. So it's $66 a share now. They think it could be worth $169. So I am interested. And the thing that we always have to recognize is the market has to recognize that the stock is undervalued. So as these cost incentives go in and there's more revenue, there's more earnings, then you're going to get the market to recognize that the stock price is undervalued, and it will go up. And so I do love a bargain. And I think this is the last slide, right, Mark?
Yep.
Yep. So
it's
if you like a bargain, here's PayPal.
I do like the image on this slide also, which underscores something we've talked about a little bit during bull sessions, where you kind of have to de-emphasize 2021 and 2022 for a number of companies, because they got kind of pumped up, and really pay attention to that trend. And you kind of see this here in the work done by Guru Focus. So just something to think about as you do your studies. Good stuff. Thank you, Kim.
Mm-hmm.
All right, I'm going to close up tonight with just a couple of things here. This is a shameless promotion of kind of a study that Ken and I have done over the last 3 weeks during bull sessions, where we're taking a look at the rapidly expanding infrastructure in our electrical future. And pretty interesting thing when you think about the big data and all of the transmission and distribution stuff, and just the electric vehicles, and there's just a whole lot happening. And I really was tempted to go to that portfolio. We created a portfolio. You can actually access it down here and peel off one of those companies for tonight. So you can actually go to that link, take a look at the 20 companies we've identified over the last couple of sessions for that portfolio and take a look. But instead, I basically pulled up a quick screen. And much like Kevin, I'll tinker with doing a few extra things every once in a while. I wanted excellent companies, hence the quality greater than 80 that you see over here on the right. I wanted the projected return on value to be 15% or more. And then I'm kind of going to be a stickler right now because things are still a little bit uneven, and I want a decent financial strength. And then I really like the idea of not looking for just small companies, but incorporating some of the more medium-sized companies into the hunt. And so those 4 parameters generated this list. Cy presented Taiwan Semi last month. We have talked about MP Materials here before. It's also one of our best small companies. The next couple are kind of intriguing. I'm not so sure about some of those numbers on SQM. Probably deserves a quick audit, but there's a number of companies going down that list. Borg Warner makes the list. Some others that we have featured here lately, but I was kind of in the mood today for I want to buy a bank. And it is, it's a one-time thing. Could work out. Might be a little bit frisky right now. But the number 1 bank ranked by quality on this list with an elevated return forecast is Western Alliance. And again, I'm very familiar with the trepidation in that market, and regional banks are clearly loathed. I'm going to just invoke one of Hugh McManus's rules to live by. When there's a whole lot of loathing going on, you might want to start shopping right there. So that's what we're going to do. Going to take a look at these guys. Western Alliance Bank, it's no stranger to us here. I think we've selected it 5 or 6 times. It has languished here over the last few months. We'll actually take a look at that. But again, here is a very primary indicator for any bank, especially these regional banks, when we're looking at, how has the company behaved over time. This is return on assets over time. And you can see that blue line across the middle there is, what we define as pretty good bank. And you can see, and up here, these are like really good numbers up here. And you can see they have spent most of the last 10 years in that really good range. So that alone is attractive, and we give them a little bit more leash as a company we might consider investing in. Now, it has been a train wreck. This is the last 6 months for the company. I remember this morning here quite well. Actually bought some in the morning and sold it before the end of the day on this huge rebound that actually happened that day. And then we had an encore performance a few weeks later. This is not normal stuff. It's just not normal stuff, and it's been kind of nasty. I would point out that outside of the really deep excursions here, that it has spent a pretty good, strong amount of time, in that channel. So it's just something to be aware of. And chances are that it actually finally has found some support at that 30 level or so. So again, this is not normal stuff. And over the long term, you can see how unusual it is. Notice the huge spikes in volume here. That's clearly a frenzied mob and or a bunch of robots doing some program selling in those moments. So those monthly situations are shown right there. Again, they have been tested back in COVID. You can see the response coming out of COVID was pretty good, maybe a little bit artificially stimulated, along with many other things that are going on. But again, that long-term blue trend, that's a trailing 5-year average, is pretty solid. So it has had some pretty serious excursions. But when you look at the company, from 35,000 feet, the quality is improving. We do notice that the return forecast right now is up near multi-year highs. The book value has flattened, but it's still at a fairly decent rate. Pick your number, anywhere from 8 to 12 to 13, anything in that range. It's not going to be in that 16 to 18 range anymore. But it's topping out. It's gotten bigger. You can see that huge price excursion down here in this graphic. It's just amazing when you see it laid out like that. And again, with a growth rate somewhere around 10 or 12%, a projected return on equity of 15, which is something they've actually achieved pretty regularly. Remember that number. And a PE in the high single digits, you are still looking at a 21% return. And again, as a reinforcement, 5-year average return on assets is in great shape. Very high quality company. So I'm starting to feel much better about this. Some of the other stuff that as you look down the page, they're kind of in the middle of that range they've been bumping around in. The experts believe that this company currently priced around 37 could go to 71 in as little as a year. And I find it fascinating. This is probably overdoing it a bit. Morningstar has recently raised their fair value up to the $99 level. So these guys are at a price to fair value of 36%. The rhinos agree. These are deeply undervalued, could be a value trap. So all of this is going on. There's a decent article just this morning on troubled banks, including PacWest. But in that article, they cited the CFO of Western Alliance saying, our deposit characteristic is actually looking pretty good these days. And the stock price did go up today, 2%. So a lot of what's going on at the bank, they're not doing a lot of things that got some of those other banks into trouble. So it is one of the friskier banks, but it does top out on the quality chart with a decent elevated return forecast. I think it's worth rolling the dice a little bit. So with that, I'm going to urge us to put another $1,000 into Western Alliance and hope for formidable price recovery. All right. Hopefully I was kind enough to your bank, Ken.
I just don't talk about it very much anymore, Mark, but I certainly feel the same way you do about it. So here's our poll for this evening, folks. Help us choose an extra $1,000 to go into one of the 4 companies. If you don't like any of them, then of course you can pick none of the above. And right now we're just asking you to vote. We'd love to have 80, 90% of you voting. And we're moving up to 70%, so it doesn't take anything, doesn't cost you anything. Just choose one of the companies if you would. There, we've just moved over 80% voting now. Let's give you another 5 seconds to pick one of the 4 companies.
I think I'm going to call for a revote.
A revote. Okay. Okay, and I am going to count to 10 in my mind now.
That's only because he's lagging me by a couple points.
Still getting votes in here, and we'll close the poll, and we'll share the results. And they like the shortest presentation of the evening, Mark. Okay. All right, so we'll put an extra $1,000 in Visa. PayPal, Kim, you had a third of the folks liking PayPal an awful lot, and Western Alliance and Charles River are tied at the back end right here, right now. Maybe if you guys would shake hands and just get along, you'd get more votes, you know.
Well,
Ken, I'm really disappointed because I sort of look at, getting more people to vote for my selection rather than Mark is that sort of like the Mendoza line in baseball. And so I have to get over the Mendoza line. It's sort of like trying to outperform A2 Milk. You know, it's the same thing.
Oh,
So
that's
Mark,
low. That's
I've
low
hidden
blow.
I've hidden the poll, Mark, and if you want to go to the next slide, there we go.
All right, just a quick reminder that we do archive all of our roundtables and the bull sessions on the Manifest Investing channel at YouTube. And we do endorse the work done by Mr. Glogly over on their YouTube page also. Would encourage you to check it out. I think I'm going to crash one of his sessions and see if I can't work up a little bit of a storm with Ken Williams or something in the near future.
Promises.
There you go. Good stuff. All right,
So
we are heading into the. Go ahead.
Go
Ken.
on, Mark. Continue.
I was just going to say we are heading into the summer season. Things do slow down a little bit, and we will be putting some more stuff together. I know I keep saying that, but as Ken knows, I've been kind of busy lately.
Yes, he has.
Hopefully that can change again here fairly soon. But the July roundtable will be on the 25th, a month out from now, and we look forward to doing that. And both Ken and Cy will be part of an investor day in Atlanta in the middle of August. Anything else you want to add to that, Ken?
I'm just thinking Atlanta, the middle of August. I'm just thinking about it, Mark. Okay.
Well, I can remember sweating at the train station in Atlanta in August a few years ago. So that.
Oh, Mark, you're going to be in Traverse City on the 1st of August.
Oh, I should put that on here too. August 1st, going to be visiting Herb Lemkool and one of his affiliated investment clubs up in Traverse City. So we will get information on that on the website.
Just if you're going to be around beautiful Traverse City at that time, it's August 1st, isn't it, Mark?
I believe so. Yes.
Yeah. Drop Mark an email and he'll give you directions to where it's going to be.
Absolutely.
It's also the Portable Value and Model Investment Club, so it'll also be online.
Cool. That's Charlene Hansen and her crew. And Charlene has been a presenter a couple of times for us.
Without further ado, I'd like to thank Kevin. I'd like to thank Kim. Herb, it's great talking to you again. And until the 25th of July, we wish you all better investing. We hope to talk with a number of you at bull sessions continuing. If you're looking for a bull session on the 4th of July, there isn't going to be one. So don't try to log in on the 4th. That's next Tuesday. But we will resume bull sessions on July 11th. So with that, good night. Again, thank you so much, folks. This program is dear to many of us, and we're so glad that we can keep it running for as long as we've been able to do so. Good night, everybody.
Thanks, Ken. And thank you, Kevin and Kim.
Thanks all. Have a good night.
Have a good night, everyone. Cha-ching to all.
She's back.